So let's get right now to it, kind of broaden it out. Joining us on set, Steve Sosnick, Chief Strategist at Interactive Brokers. Very good day to have you on. I don't want to make too much of it. We're down 1.5% to 2%.
Yes.
This has been a heck of a rally and a heck of a run. So we're just kind of back to where we were about a week and a half ago. But what is the risk, Steve, of some or any escalation with China?
You know, we'd gotten off the idea that tariffs were a problem. We got off the idea that trade war was going to be a problem. And I think we'd gotten very complacent. You know, someone this morning asked me, why were we up? And I gave them the flippant answer because they rang the bell. And I think that was kind of the mindset we'd gotten into. And I think every so often the market needs a reminder that risks are out there. It's too early to say whether this is, you know, a tidal change or just a rogue wave, so to speak. But this is really the reminder that risks are always ever present, and sometimes the less you perceive the risk, the more they're lurking.
Well, complacency, I would imagine, is in some ways the enemy of the market, is it not?
Absolutely. You know, it's interesting because I've had several conversations recently with institutional investors, all of whom are getting a little bit more nervous about what's going on out there, thinking this is going on.
But they're probably still buying, Steve.
But they're still, well, I don't know if they're still buying, but they're still long.
Or they're still holding. They're not selling.
That was exactly my next point, is in many cases they're holding their nose and owning them because professionally they can't risk not being invested in the names that are working, right? I mean, you know, if you have very narrow leadership and you're not invested in those names, you're underperforming, and that's a big problem.
Nobody wants to be the first to leave the party.
Exactly. And so today, that's why I think it was interesting that, you know, let's put it this way, the news about the rare earth quotas came out last night, and the market didn't react to it. It wasn't really until we had the angry reaction from the president, which, by the way, did escalate. It is escalatory. I don't know if it's fully escalated, but it's escalatory language. And that's when the market reacted. It wasn't really to the first piece of news that triggered it.
And I know I'm asking you to speculate, so this is all kind of happening real time. Mm-hmm. Okay, as I said earlier, it's a rip up the scripts,
absolutely,
rip up everything kind of a day. Let's just have a conversation. Is this the reaction to higher tariffs on China, or is this a small startup reaction to the potential for higher tariffs on China? And if we really get them, that this might just be the start.
I think right now we would classify this as the start. I think the key to me will be, do the buy the dippers show up? Because they've been the most reliable people in this market, people buying this dip. Today, we've not really had a meaningful bounce. A lot of times you get a meaningful bounce on a Friday afternoon just because options are expiring. We're not, you know, on 600 plus weekly names. We're not seeing that as of yet. I think this is a little bit of a reminder because look at the way the VIX went from 16 to like 22 in about a microsecond today. And that's telling us that there were people caught on the wrong side of this.
But that also means that, and we know the VIX, often called the fear gauge, is really just a measure of options and option spreads.
Exactly.
So what does that tell you at Interactive Brokers about how people were positioned and now are changing that position?
You hit it perfectly. It's called the fear gauge, but it's really not. To me, it's a great proxy for the amount of institutional hedging demand that's out there. And we didn't see that much demand for the hedges. Now, the underlying volatility was very low, so you could argue VIX was actually maybe a little fairly priced. But the reaction that was obvious that people were caught offside, it was obvious that people had been selling implied volatility, they've been selling volatility, and then had to play catch up in a hurry.
So what does that do to the market then? If you're selling volatility, do you come back in later on?
Assuming you
haven't gotten your face ripped off.
Bingo. Yes.
And you still have some money.
Yeah.
left.
Then you
yes.
try again.